Hello and welcome back to The Note. Sometimes revolutions happen quietly, and you could argue that is the case with exchange-traded funds, ETFs. Over the last decade, they've come to have a very great and growing influence over markets, and they didn't even exist some 20 years ago. So I think it's worth taking a 40,000-foot view on what the ETF industry has become and how it might change in future. With me to discuss this is the ideal person for that. She's one of the world authorities on ETFs, the founding partner of ETFGI here in London, Deborah Fuhr. Debbie, thanks very much for joining me.
Thank you.
Let's start by the overall chart showing the extraordinary growth in ETFs, both the assets they hold and the number of ETFs. How much further can this grow? What has been driving this growth?
Well, I think ETFs can clearly grow a lot further because what you find is they're a very unique product in that they're very democratic. And by that I mean they're being embraced and used by large institutions, by financial advisors, and by end retail. So that's a unique proposition that you don't really see in any other financial product. What we're also seeing is that many people are embracing the idea that using passive or index-based ETFs to invest in markets where they don't have skill or expertise, or they're using them as building blocks to generate alpha by doing asset allocation. So what we are seeing is that financial advisors are moving from being paid to sell products to being paid for advice. And as that change happens, what we're seeing is they are increasingly embracing ETFs. And that has caused, in the US, we see that ETFs are used by retail and financial advisors. About 50% of the assets are with that segment. And so we're seeing those changes in the UK, in Holland, in Australia, and we expect that will happen across Europe and probably move to more of Asia.
Okay, so one of the critical points there, therefore, is the importance of low costs. This is a cheap way to do things. One thing that might be a concern, however, is that it appears from this chart that you've produced here that the smaller the ETF, the weaker that advantage, the higher the costs. Is there any risk that there are too many small ETFs out there to blunt the proposition?
Well, there are a lot of small ETFs out there, but what you do tend to find is equity-based ETFs on average are 31 basis points, fixed income on average are 20, and then as you move to commodities or leverage or inverse, the fees tend to be higher. So in general, even when they're smaller, you can still find that the fees will be low, but as assets grow, many ETFs, the fees come down. So you are right that the larger fees tend to be lower, and so that would be a concern.
Okay, now let's take a look at who's actually using them. This is the historical reported holdings by institutions. How much further can this go? This is basically something that has only happened inside of the last decade that they've been using these.
Yeah, exactly. So this is based on reporting holdings from Thomson Reuters collects shares that everyone holds in mutual fund holdings. So it's gone from 154 institutions in 1997 to 3,367 in 2012. We expect this to still continue to grow significantly because as investors are looking to invest in more markets, more asset classes, they rationalize where can I generate alpha myself or find active managers who are doing it, and where they can't, they increasingly use ETFs for market access to other asset classes. And so the growth in passive investing and the growth in smart beta and other strategies is also going to push more institutions to use ETFs, and many are wrapping ETFs into offerings.
Okay, so that comes on to a final issue. Obviously, ETFs have supplanted mutual funds in a large part when it comes to passive investing, but what about active investing? If we take a look at this chart, plainly it's much harder to make sure that you don't end up trading at a discount to net asset value if the fund is active. Is there a future for actual active ETFs?
Well, I think there are. What we see in this chart is these are transparent active products. We have to be careful because many people are calling smart beta indices active, and so this is only looking at people who are fundamentally picking stocks and bonds.
So this is truly discretionary rather than some quantitative index.
Exactly, and so what you see is behind these numbers is right now the people who are happy being transparent are fixed income managers. So the most successful ETFs today would be from PIMCO, global brand. Bill Gross, people know him, know his products, and so he's launched ETFs on similar strategies to he's running his funds. And so people are increasingly using these things. We also have the future, which is filings with the SEC for non-transparent active products. And so we will wait and see whether those actually come to market, which would open up a whole new universe of assets and types of exposures for people to look at.
Okay, Debbie, thank you very much indeed. I hope in 5 minutes we came reasonably close to covering quite the extent of the ETF revolution. I think the most important point to be made about it is that it isn't over yet.